Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. Josh, how was your week, mate?
Steve, really good, really good. Lots happening. What are we, about a month out from the end of the year officially? So it's coming in quick. So a lot of exciting things on the go in the business, in life. My son is officially over 2 weeks old now, which is great. We're back home. We've settled in. He's putting on weight. He's like his father. He loves eating a lot or drinking a lot. He's doing really well, and no complaints on my end other than things are just busy, but that's normal. What about you, Steve? I know you got lots on the go, and you're racking up those flying hours at the moment, aren't you?
I am, mate. Yeah, I think this month I'll nearly hit 20 flights in a month, which is probably my biggest time on a plane. Yeah, so this week was 3 different states, and on Sunday I go to Singapore for some business and into Philippines and back again. So
why not?
It's all happening. But that's why we love it. We chose this life, mate. We've got to stick to it. So that's why it goes. So but we rip in another episode of this week, mate. We're talking about investments in general. Open conversation around investments. We might touch on a little bit about alternatives. But if we kick off, mate, what's the latest trends with investing? What are you seeing out there in the market? What's different from what it was a couple of years ago? Where are we headed?
Yeah, well, obviously, I think seeing a lot more exposure now, like, post-COVID, a lot more interest in it. I think there's a lot more education, and obviously information is just so more readily available these days. It's not difficult to go and open an investment account and start buying some shares. So I think a lot more people are interested in it, which is a great thing. Right. However, I think then it also raises the part of doing it right. And everyone usually starts out in their investment journey the same. I was no different. When I go back to when I was a concreter back in those days, I had my little share account and I was picking stocks and I had no idea what I was doing. I look back on my time and I bought one company. It was a gold mining company. I don't know why I thought it was going to go to the moon, and it to be fair, it went up a bit to begin, and then it come crashing down, nearly went to zero, and I luckily held on to it and got back to my break-even point and sold out, and now that company doesn't exist. So yeah. I count myself very lucky for it. But there's definitely a right way to go about getting started on your investment journey. And this is where you got to speak to people that have done it as well, because we all generally make the same mistakes. And like I said, stock picking, everyone usually thinks that's the way to go and begin and get started. But I definitely think the trend now is getting better, and people are looking at ETFs and index funds as a great way to get started, which is what I definitely practice and preach when I speak to my clients. I still invest a lot of my money like that these days as well. But I guess there is a large universe of investments as well that you can pick from, and that's probably the critical part you need to get right around, property, shares, like what's an ETF and bits and pieces. And then there's something called alternative assets, which we'll touch on as well. But what about you, Steve? What are you seeing out there? Any particular trends on your end?
I think the latest trend is probably looking outside the box of the traditional ways to invest a little bit. I think, like you said, I think, the way I sort of position with clients, I always have that foundation of investment that's just going to tick over, right? You're not going to shoot to the moon like you tried to do with your gold stock. But, if you just create that foundation of investment and you do that through your index funds, your ETFs and the whatnot, and that, make that your guaranteed future, right? Tick, done. But then once you've got that all sorted, then outside that, I think people are getting more education around other types of investments, maybe unlisted types of investments, investing in businesses, whatever that may be. I think that's starting to probably become a bit more of a common conversation. People are always searching for the what next, and I think the what next now is probably a little bit different to what it was 20 years ago. The what next was probably 20 years ago investing in an ETF, right? But that's 20 years ago, and we've had 20 years of that now. And so now people sort of go, okay, what else is out there? And I think we're having conversations a lot, and we just got back from the States where we did a lot of research around this particular topic, which is alternatives. And the word alternative can mean many different things to pretty much every single person. Yep. What I'd say is just not the traditional. So it's just not the traditional way of investing, i.e. it's not just investing in an index fund that's got the top 500 stocks on the stock exchange. alternatives are generally outside the box a little bit. Okay, so maybe unlisted assets, it might be direct commodities, it might be Bitcoin, cryptocurrencies and the like. And I think people are asking more questions around what next now.
Yeah, so I don't think the status quo really sort of takes it anymore. People do want more. They want to, and I think a part of it sometimes, yeah, you definitely need to be careful because it sounds all good and well going into some of these investments sometimes, but you can quite easily lose money, and particularly when you start looking at these unlisted and alternative investments, you're typically dialing up your risk as
Yep.
well with some of it, and because some of it is you are going into businesses, like you're buying unlisted businesses that aren't on a stock exchange, and they could be little small businesses that are just getting started out, and there's probably no greater risk when you're going into a small handful of companies as opposed to just buying an index which owns, like you said, 500 or 200 or 300. So with those extra risk you're taking on board, you're definitely return potential is going up. And some of the alternative assets that we see when we're just over in the States, like most of those funds and private equity funds, like they're looking at minimum of 10% net returns. So net returns we were talking about on our podcast last week is around, that's the return after the investment manager takes their fees. And the fees are generally higher on those types of investment options. But like we said, if you're getting it's not a guaranteed rate of return, but if they've got a track record of delivering that rate of return, even if they're charging you higher fees, well, that's not a bad deal. But usually when the returns, as your returns keep dialing up, so does your risk, and that's something you definitely need to balance. And how do you go about then balancing that when you got clients, Steve, that maybe they've got a bit of money to actually throw around here, and they could maybe start looking at some of that? Like how do you start building a bit of a portfolio?
Yeah, and I think this is the part the advisor really can add value, right? Because it's a balance. It's an absolute balance. You've got to make sure you've got the guaranteed future. You can't risk that, right? We've got to make sure that's ticked off. So whether it doesn't have to be immediate, but we've got to have a plan in place to get there.
Yep.
And then once that's done, well, then we can absolutely allocate some money to alternatives or different types of investments. But that's my job, is to work out what that balance is, right? Because absolutely, we want to take those opportunities if they pop up. There's some fantastic opportunities out there, and it's allocating a percentage of your cash to those and working out what that allocation should be. If you're just getting on your journey of investing and you haven't got a foundation yet, well, it's probably going to be zero allocation, right? But if you're halfway down the track and you've got a fairly good asset base already, we're on the journey, we're kicking goals, absolutely, let's maybe look at allocating some over to the other side of the fence in terms of those alternatives and taking a bit more risk, because we can, and hopefully reaping the rewards. But it's what I'd say is getting that balance right is key, and secondary is do your research. Like you've got to understand what you're investing in. If you don't understand any investment, you don't go into it. It's as simple as that. The amount of people I see throwing money at cryptocurrencies and have zero idea about how it works blows my mind, right? I don't understand that. How can you be investing in stuff you clearly have no idea about? It's just 101 of investment. So people need to get the right advice. They need to get the research done, spend the time doing it, because if you don't do it, you're just going to lose money, effectively.
Yeah, no, I think that's a key learning as well, because like I said, when you start out buying shares, like if you're not doing your research, you actually are gambling. It's no different than going to the casino and throwing some money down on roulette and just hoping you hit it out. And I was not, I wasn't perfect for that. I was doing exactly that. Like I thought I was doing some research, but I had no idea about a gold mining company. I didn't know what they're doing. I just read some of their, reports and financials. I'm like, oh God, this sounds great. So, I think everyone's definitely open to making some of those mistakes, but how do you not do them? Is we just learn from people that have made them before you. And I think I think if we try to paint a bit of a picture as well, as like, when can you start going into those funkier type investments? I think what you said there was great, because, you want to have at least your core portfolio down. So it's not when you're at the beginning of your journey, you're probably not looking at these more alternative type investments. Like you've got your core portfolio down. And if we try to paint a broader picture, maybe you've got at least a home or a roof over your head that you own. You've probably got your mortgage under control. And what I mean by that is you're probably not, right up to 80% loan to value on that. You've actually paid down a bit of your mortgage, so you've got a bit of a buffer there. can ride out some higher interest rates, or if interest rates, are to go up, maybe you've got a bit of a cash buffer there. And so you've got your property, core portfolio, cash buffer, and you've got a bit more security behind you. And then that's when you can start actually taking a bit more calculated risk. You're not gambling, but calculated risk. And, I've got some friends of mine and people that I see in business who now have worked themselves to a point where they can jump into different ventures. And, I got a friend that is in, one field, and then he's totally in another field and owns a cookie business. That's an alternative type investment, and it does great. I love those cookies. So it's but it's not what you're doing at the beginning of the journey though. Like there's kind of levels, I suppose, in a way to the investing game. Yeah. And if you try to sort of skip those levels, and you're just probably going to get some really hard lessons, and some of those hard lessons could nearly knock you out entirely if you get it wrong, depending on the scale that you're trying to do it. So it's a risky game, but it can be fun if done right.
Yeah, and how long have these types of investments been around for, mate? Like, what's the because there's a bit of talk about them. Is it been around forever, or the new, or what's your take on that?
Well, I think the investments they've always kind of been there, but I guess some of the vehicles for the everyday person to get exposure to probably weren't always there. Because we were in the US, and we were on the stock exchange, and we had a great tour of the New York Stock Exchange, and they walked us through the whole history of how trading used to be done. And it used to be done on a floor where people would be screaming out and just have paper, and you'd have to physically go up and buy stock. So that naturally would limit who can buy companies and invest. But whereas nowadays, I just register for free on an application, and I could buy probably nearly any listed company around the world. Yeah. So the vehicles and instruments out there these days to invest that's continuing to develop, and now we talk about these alternative investments, which were typically investments that were probably more for higher net worth people. Now the fund managers and all the investment managers are coming out with options that the everyday person can now start to get access to. And what I mean by that is generally most of those types of funds might have a minimum investment threshold of 20, 50 grand, 100 grand. Some funds we've seen in the US were $500,000 plus. So that's not the everyday person that's just got that to invest. But now there are solutions and vehicles coming out that will give you that type of exposure, and you can get your sort of seat at the table with a smaller amount of money. And with micro investing apps these days, they weren't around 50 years ago, or 20 years ago, probably even 10 years ago. You always had to invest with at least a certain amount of money of $500 a month or whatever it may be because of the fees. And then in the last sort of 5-ish years, now you got these micro investing apps where you can literally round up every dollar that you spend, and then that goes towards your investments, which I think is amazing. So it's all going in the right direction is everything I can see.
Yeah, and I think what will be fascinating in the next 5 years, where how it evolves. I think it's, as you said, it's evolving so rapidly now that I think in 5 years' time it's probably going to be completely different, right? So I think watch that space, and I think that's where an advisor needs to be staying up to speed with all those options and what we can do and not do, and play around with it, because everyone's got sort of their own idiosyncrasies, right? So every client has different needs, different wants, different goals, and how that balances up and marries up to the underlying investments you're in, and timeframes and tax profiles, and it's all going to change. So it's just so important to again research, understand it, stay on top of it, and if you can't do it yourself, obviously get good advice.
Yeah, you get an advisor, and I've got some clients that definitely want to be a bit more hands-on, and some of them want to get a bit speculative with what they're doing. And where I normally say, or what I normally say to my clients is, if you want to have a bit of a punt with some things, because you kind of are in a way, maybe of your portfolio of 100% of it, 5 to 10%, if you want to have a bit of a stab at some types of investments and you want to do it on your own, I'm fine with that. I do that with my own portfolio. I have all my investments, but then there's some that are right in that speculative basket, which could actually go to zero. But if they went to zero, they wouldn't really dent anything. It's not going to destroy me if those investments go to zero. But if they go to the moon, well, then I'm gonna make a heck of a lot of money. And again, that's where a good advisor can actually come in terms of educating you around that. Do you have a similar philosophy, Steve? Do you have clients that want to have a bit of a nibble themselves?
Totally. And again, if they're on that journey, or they're halfway on the journey, they got the foundation, they got the core investments, so investment properties, share portfolios, managed funds, etc., and they're on the journey, well, absolutely. Let's, no problem. There's no issues having a bit of a play around and doing that. And I do it myself, exactly the same as you. Like I've got, we've got investments, we've got businesses, we've got houses. You sort of covered, right? So I can take that punt. I can take that risk. And as you said, if it goes to zero, well, I've taken. I know can be the outcome, and I know the risk of that, and I'm okay with that. That's fine. It's because some will go to zero, some might go times 10, some might go times 20. Overall, obviously, you want to win, but the reality is that when you're investing in that stuff, you've got to accept that it can potentially go to zero. So, and if you're okay with that, and you've got everything else sorted, well, by all means, go for it. I still personally think the best investments are the companies you work in, because you've got direct control. So, and realistically, that is the best investment in my view, because you've got direct control. You look at it every single day. You know the back end of the details, like there's no tomorrow, and you're a master of your own destiny. So you can create wealth unbelievably well when you've got that control. And I'd say that's, to me, the best way to make money.
And the part I would add on to that is the best investment, in my opinion, with that would then be like yourself. Like if you have a company, you're kind of betting on yourself. And therefore, sometimes I get asked a lot, like I've got 10 grand or 100,000, where should I put that? And first and foremost, I should say you invest in yourself. And that could be through courses, educating, reading books. That could be paying a financial advisor or getting a mentor around you to show you the journey. So the number one investment you can always make in yourself, hands down, 100%. Before we close out, Steve, what about like liquidity? What does that mean? Can you kind of talk us through liquidity? Like what's a illiquid investment? Do I need to be concerned about that, particularly with some of these other investments like property, alternative assets? What do we mean by that?
Liquidity is being able to get the cash back. So how easy it is to sell and get the money back. End of the day, there's no investment that's any good if you can't get the cash, the physical cash. So if it's really hard to sell, it's called illiquid, right? Because we can't, there's no market to sell it on, or there's no buyer, right? It's all about, is there a buyer to buy your asset? So it's really, really important to factor that into any investment conversation or decision. We've got to make sure we can get the cash back at some point. That may be well down the track, or it might be tomorrow. And as long as you've got comfort and you're comfortable when that event can occur, but if you never get it back, doesn't matter how much it's worth. Could go to $100 million. If you can't get the cash, well, it's worthless. Right. So people need to absolutely factor that in along with the tax and everything else, but getting liquid assets, and you don't need to have them all liquid. You can absolutely have illiquid assets as long as you do have other assets that are liquid. Because if you need the cash or something happens in your family arrangements, or you have a baby like you do, well, clearly you've got to go buy a cot, and to buy a cot you need cash. So, so it's just really important to balance that out. Understand when the liquidity can occur and when you can get that cash back, and absolutely factor that in, because if it's not liquid, it's a lot more risky, and you've got to make sure the returns are up if you can't get the cash back quickly. So it's really important to factor in that risk return conversation with the liquidity conversation.
Yeah.
If that makes sense.
Yeah, and it does. And I think that's with some of those alternative investments that we're talking about, they can give you higher returns. They're generally more illiquid funds. So you can't actually readily access your money and sell out. There might be limits to how much you can actually sell out on a monthly basis. Whereas if you compare that to a regular investment portfolio in an index or an ETF, traded on a daily basis, you can sell and get your money, within 48 hours, because there's generally always going to be another buyer on the other side of that. So like you said, it's a combination of having some liquid investments that you can always sell, and cash would come into that bucket. Having a cash buffer, we've spoken about that a lot lately. Your shares, your ETFs, they're all liquid. You can sell them quite easily. But then you've got your illiquid investments, which is typically like your property. You can't generally go out and sell that overnight and just pull out a little bit of money. And then you've got these other alternative assets and other assets in the total investment universe. So I think it's a really good way to end, and where we'll finish up today. Guys, if you're getting value out of it, of course, 5 stars, Spotify and Apple, it does help us out a lot. Check out all of the social media channels that we have on the go. Steve's newsletter as well goes out every week that you can subscribe to. And if you want to have a chat to any of the financial advisors about your own personal investment journey or financial journey for that matter, please do jump on the website and feel free to take your pick. Steve, it's a Friday. I'll leave it at that, mate, and I'll see you in the next one.
See you, mate. Bye.
Catch ya.